we have membership in Flya. It's a very diverse group of members, and I want to thank each and every single one of you for being involved in your support. Without your support, none of this would have been possible. We're on part 7 of our journey together in 2020 on real estate, direct lending, and private debt. So, with that said, I just got a couple of slides to go through as we get ready for our 2:30 presentation. Special situations marketplace. Please reach out to me or someone on my team about listing your opportunity in our marketplace. It's a very unique marketplace that has a lot of interactive features, and I'll be going into that at 3:30 today. Part 8 is November 19th, coming up here in less than a month, and part 9 will be December 17th. So if you haven't registered, go to the site, click on the image, and register. My apologies for the noise that's in the background. The building never cleared, fire alarm testing with me. So no matter how much you plan, so that there's no complications, there's never enough planning. This is a perfect example. Here's a little image from our marketplace. Take a peek at it when you get a chance. Flya.org/marketplace. So we have a few more minutes before Jesse gets started, unless Jesse is actually on the line now and he wants to take a little extra time.
So Michael, I am here, and actually this is somewhat fortunate because I think I was going to push up against my own timeline anyway, so I will gladly take the extra couple minutes if everyone can forgive me for not getting a short break.
Absolutely. So Jesse, I'm going to stop sharing my screen and you can throw your presentation up.
Great. Thank you.
Thank you.
One moment here, guys. So I think everyone should be able to see my screen now. Private debt and real estate update.
Yes, we got it.
Great. Well, in that case, good afternoon, everyone. Really happy to be here. My name is Jesse Fay. I serve as the Vice President of Private Capital for Prequin. And in that role, I'm in charge of data quality and collection for the Americas. This is my first event for Flya since part 5 in the forum back in July. It's also been a crazy year, and I have a ton of great content to share regarding the current state of play for both private real estate and private debt. I'll try to keep moving quickly. As I said, I've got a lot of content here. I want to make sure we can cover it all. So just 2 quick housekeeping issues. Copies of the deck will be made available to all registrants after the presentation. So no worries about that. And then also please be sure to make use of the Q&A feature so I can answer any questions at the end of the presentation during the Q&A. So before we start, for anyone who's not familiar, Prequin is the leading provider for alternative assets globally. Across each asset class, we cover fundraising, performance, deal activity, and investor sentiment. This research and data has been captured by over 400 research analysts globally, and throughout our nearly 20 years in business covering the alternatives market. So on that note, we'll dive into our first topic of the day, private debt. Tracking the trajectory of the private debt industry from just before the global financial crisis to today shows the explosive growth that's taken place over the past decade. In many ways, the GFC served as a launching point for the private debt industry as we know it, with regulatory actions in 2010, like Dodd-Frank and Basel III, forcing banks to deleverage their balance sheets and clearing the way for alternative loan providers to step up and fill that void. Fast forward 10 years, and the asset class has $852 billion in AUM and looked poised to cross the $1 trillion threshold in assets at some point in 2020, with debt managers being a favorable choice for LP allocation plans through the end of the last bull cycle. Due to the nature of how performance is calculated and reported, we track AUM for the industry on a 6-month delay. And through the first 3 months of this year, AUM has remained relatively flat, although dry powder levels did recover after taking a slight dip in 2019. $1 trillion in AUM might not be in the cards for 2020 anymore, but fundraising hasn't taken the big hit from COVID-19 that many expected, and the positive trend in AUM growth is likely to continue. Dropping back into the early aughts, we can see the birth of the private debt industry, which was mostly non-existent prior to the GFC, but had great growth through the 2010s. The immediate lead up to the GFC saw a huge spike in annual fundraising figures and an even larger jump in average fund size. Both of those figures came crashing down in 2009, with average fund sizes never reaching $700 million since, and the market not eclipsing that 2008 high again until 2015, which kicked off 5 consecutive years of $100 billion fundraising, spread out amongst a good mix of managers each year. In contrast to the GFC, which saw a massive run-up in fundraising followed by a crash, the current private debt industry is much more stable and mature, at least from a fundraising standpoint. Fundraising has sat between $118 and $130 billion each of the past 4 years, spread out just over 200 managers each year. 2020 is on pace to be roughly even with those years, albeit across a fewer number of funds, which is something we've been witnessing across every asset class, and average fund size has continued to tick higher, although still not at the levels we'd seen in 2007, much less in 2008. Granted, the drivers are completely different, but private debt looks like it will transition from economic cycles much more gracefully this time around, as is a mature asset class, which has earned its place in LP portfolios. The impressive fundraising performance comes despite some rather lackluster distribution figures from private debt managers. Unlike most private capital asset classes, net cash flow for LPs from their debt portfolio has been flat or negative for most of the past decade, with capital calls coming faster than debt managers can return capital. That was made abundantly clear last year as net cash flow fell to its lowest level since 2008. But negative cash flow is not due to lack of performance. Rather, private debt is a victim of its own fundraising success, scaling at such a rapid rate that managers are calling capital for new funds before they're able to exit and return capital to investors. That speaks to the great confidence that LPs have in the asset class, that they're willing to keep allocating large chunks of capital before their initial investments are realized, and the importance of private debt in the late cycle especially. Overall, dry powder is at a healthy level, rebounding from the 2019 dip to hit a new record high year to date. I said already how the GFC signaled the launching point for private debt, but what would be more accurate is to say the 2010s saw the rise of direct lending into the dominant strategy within the asset class. Direct lending was basically non-existent at the start of the century, and now it comprises nearly half of all assets held within private debt, including adding almost $40 billion in dry powder so far this year. Not surprisingly, the other debt strategy, which has seen the strongest boost so far this year, is distressed debt managers, who have grown their dry powder levels by 26% from January to October of this year. Distressed is an easy choice along with special sits as a strategy which many expect to outperform in the current market environment. But while adding almost $20 billion in dry powder is impressive, distressed only makes up around a quarter of all dry powder for the asset class, compared to during the GFC when it was closer to half. So we're about to take a look at some performance figures for the asset class, but first, quickly, what are LPs actually looking for from their private debt investments? As with all alternative assets, diversification is the number one reason they allocate to the asset class, which makes sense. Alternative assets, you're looking to diversify and go against mainstream. But unique to private debt, however, investors expect high risk-adjusted returns to go along with a reliable income stream when they allocate to private debt managers. And when it comes to a reliable income stream, it's something that private debt's largely delivered on, with very steady returns throughout the vintages of this decade. Median IRR for basically every debt strategy has hovered right around the 10% mark across vintages, give or take a couple of percentage points depending on the year. Venture debt serves as the clear outlier here, with the emphasis on warrants, giving it the opportunity for strong outperformance, making it the top or second strongest performer nearly every vintage year that we have data for. Looking specifically at the GFC vintages, distressed debt has some of the strongest IRR figures overall, and Special Sits really shines in 2009, setting up their playbook for 2020 and 2021, and giving good reason for LPs to trust in their strategies once again. Looking at the asset class from a risk-return basis, we can see a wide spread depending on which private debt strategy you choose. Direct lending is by far the most popular strategy these days, and you can see why in this graph, since it provides remarkably steady returns, even if they are the lowest across the asset class. Venture debt, meanwhile, becomes an even larger outlier among its peers when examining the risk-return profile for the asset class. It has the highest median IRR by a wide margin and manages to offer the lowest overall risk, safer even than direct lending funds. It makes me question why the strategy is so small overall, especially given the prevalence of venture capital this past decade. But the low AUM figure is also likely helping to drive the outperformance, with fund managers taking advantage of less competition to only choose the absolute best deals. No matter which strategy you pick, as a whole, private debt performed well through the last recession, recovering lost value by early 2010, much quicker than our benchmark for the wider private capital universe did. That helps deliver on the second reason why LPs target private debt for their portfolios, which is the high risk-adjusted returns they believe it can deliver on. On the longer timescale, however, high absolute returns from private equity managed to outpace the overall steadier returns from private debt, highlighting the importance of proper diversification as the overall private capital index delivered better returns over this long time horizon. The recent strong fundraising by private debt managers shows that LPs clearly believe in the asset class to perform well through another economic downturn. Both benchmarks took a sharp dip in the first quarter, but debt managers and their investors are hoping that once again, they will be the quickest to bounce back. We'll look at the monthly breakdown in the next slide, but through 3 quarters, you would not be able to tell that there was a pandemic happening if you only looked at private debt fundraising. But even through the data, or even the data through September falls within normal variance, there are definitely some signs of weakening, and the red flags become clearer when broken out by month. Strangely enough, the first half of 2020 saw private debt fundraising on a record pace, with Q1 staying virtually even with the previous 3-year average, and Q2 actually accelerating and outpacing the former averages. H2 has been a different story, however, and fundraising has since fallen way behind, to the point where it's now trailing the 2017 to 2019 average by 15% after holding a lead back in June. Optimism from the strong start of the year aside, this was something to be expected as a byproduct of the pandemic. LPs still have investment mandates to hit, so fundraising was never going to go on pause completely. Instead, what social distancing orders did is limit the ability for fundraising meetings to take place, and in essence, have restricted the potential pool of managers to those who LPs have already had discussions with, or those that they've invested with previously. Through that lens, a Q2 spike makes sense as LPs want to close investment deals with those managers that they feel most confident in, as they have little prospect of finding attractive new investment possibilities the later we get into the year. There's a big red flag because Q4 is always the strongest quarter of the year for fundraising, and December especially is when many managers reach a final close and the bulk of activity takes place. Health data on COVID-19 is trending in the wrong direction, and many areas are talking about a potential second wave of infections taking place as we enter fall and winter. If infection rates continue to rise and the economy begins to stall once again, it could be devastating for managers who are hoping to finish their fundraising in Q4 and could make 2020 the worst fundraising year since 2014. The small number of fund closures overall is concerning, but aggregate capital raise might not look so bad, if only because capital concentration has been trending up during the latter portion of the decade. Unlike during the GFC years, where we saw a huge spike in average fund sizes, followed by a sharp contraction caused by the recession, the growth in fund size has been more gradual this time around. Since the start of the decade, funds raising $1 billion or more have been capturing larger and larger shares of overall annual fundraising each year. And so far this year, the difference is one of the most stark we have ever seen, with 67% of all capital raised going to funds at or above $1 billion, and a whopping 43% going to funds that have managed to raise over $2.5 billion. Capital concentration in '07 and '08 saw a excuse me, saw a quick market correction, but I don't think that we should expect same thing to happen this time around. The gradual move toward normalizing $1 billion funds this decade shows healthy market evolution, and if anything, social distancing and some potential manager turnover should exacerbate the capital concentration trend rather than abate it. All those concerning issues aside, fund managers seem to only see opportunity and are very optimistic thus far in 2020. '08 served as a launching pad for private debt, and it appears that the fund managers are hoping for history to repeat itself in 2020, as we've had 80 additional funds enter market, seeking over $90 billion more than what we were witnessing at the start of the year. That leaves us with just over 500 total funds in market today, a nice milestone to hit, and nearly half of them are composed of direct lending funds, mirroring the trend of the 2010s, which is direct lending dominating the fundraising space. That is just where the market currently is, and the strategy will likely continue to grow. But current macro trends favor distressed strategies, and both distressed and special sits managers are looking to take advantage of that. We currently have 67 distressed funds in market, a 43% increase from what we had seen in January. And special sits funds have seen a 12% jump in managers seeking capital from just 10 months ago. Between them, it equals 140 managers seeking an even $100 billion in capital, a truly massive sum, especially during a recession year. Fundraising has been strong with all things considered, but deal activity is an area where we are really seeing the pandemic show up in the data. Deal activity has been pretty strong in recent years, eclipsing 1,000 deals 6 years in a row and $75 billion in debt size for the last 5 years. As you can see, 2020 is well behind the pace from those years, and both volume and aggregate debt size, so despite all the dry powder, managers aren't finding many deals to invest in. Even before the pandemic was declared, deal volume was lagging steadily behind the previous 3-year average, and once the pandemic was officially declared in March, volume fell off a cliff, averaging barely half the regular number of deals every month since. At this point in the year, we've seen 60% of our usual deal activity, and fears of a second wave would be even more damaging to deal volume than it could be for fundraising activity. There have been some large deals which saved the year a bit on a debt value basis, but overall, 2020 has been a struggle, and basically every industry has felt the effects so far. So in summary, private debt's had a strong start to the year, but as the months go on, the effects of COVID-19 are becoming more pronounced. Coming into the year, there was a real chance that private debt could surpass the $1 trillion mark in 2020, but sitting currently at $850 billion, COVID-19 has likely dampened any momentum to get us that milestone. That 850 figure includes $300 billion in dry powder, larger than the entire AUM for private debt combined during the GFC, and more than ready to capitalize on any dips in asset prices or opportunities in the market. Another major difference between now and 10 years ago is that what we see today is a mature asset class. Fundraising has been very consistent over the last 5 years. Leading up to the GFC, we saw a massive spike in capital raising, followed by a crash and slow recovery, something we shouldn't expect to see in this recession. One reason for this is that returns have been solid and steady throughout the entirety of the past decade, performing especially well during the GFC and delivering on the reliable income stream that LPs love to target the asset class for. In 2020, fundraising actually had an incredible start to the year, with H1 numbers surpassing the previous year and being the second strongest H1 for private debt ever. Since the initial burst of activity, fundraising stalled, however, with Q3 being positively anemic and the prospects for Q4 also looking grim. Despite that, managers are rushing to launch new funds, so there's optimism that capital will continue to be allocated towards the asset class despite recent numbers. In particular, distressed funds have been doing very well, leading the way for fundraising the past couple months and seeing a big increase in new fund launches through the pandemic. However, deal activity has slowed, and even with some large deals still taking place, volume is way down, and it seems like it'll be a while before we see a full recovery. Okay, so now we'll transition over to private real estate, which unfortunately has had a much weaker 2020 than its debt counterpart. Despite a terrible start with the Great Recession and mortgage crisis, the 2010s ended up being a great period for private real estate, going from roughly $400 billion at the start of the decade to surpassing $1 trillion in AUM as of September of last year. Of that more than $1 trillion in AUM, a third of it sits in dry powder, ready to be invested towards any dips in asset prices as a result of recent market conditions. And given that the last recession was close to a worst case scenario for real estate, I'm sure that many managers are eager to deploy their dry powder this time around. That huge growth in AUM and healthy dry powder figure is in large part due to the impressive fundraising over the past few years. Fundraising has been incredibly strong, clearing $100 billion in capital raised each of the past 7 years, with 2019 being the best year yet with a record $177 billion raised. It took a while, but the asset class has been raising capital at pre-recession levels since 2015, along with a healthy number of funds closed each year. While 2019 brought a record in capital raised, it was across over 50 fewer funds than the previous year, following the same pattern of capital concentration and larger average fund sizes that we noted in the private debt overview. 2020 obviously will not keep the same fundraising momentum going. However, it's already surpassed the $100 billion mark, albeit on what might end up being the fewest funds closed since the start of the decade. Despite recent years of strong fundraising, dry powder has actually fallen year to date, falling back below the $350 billion mark. That downward swing in capital is rare and concerning, although overall dry powder figures are still much better than what it was leading up to the GFC. Chief among those are opportunistic funds, which currently hold $123 billion in dry powder, more than any other private real estate strategy. During the GFC, opportunistic strategies also saw the greatest amount of fundraising within the asset class, so that large pool of dry powder could see itself increase during Q4. Distressed funds represent the smallest pool of capital, so an uptick in fundraising there would be necessary if a large amount of distressed opportunities begin to open up. The recent strong run of fundraising years makes a lot of sense when looking at the influx of cash LPs have been receiving from their real estate investments. From 2013 onwards, LPs have been net cash flow positive every year, with distributions in excess of $200 billion between 2015 and 2019, peaking with net positive cash flows of nearly $100 billion in 2016. Since then, distributions have lagged as capital calls have climbed higher, leading to net cash flows closer to zero in 2018. However, that was followed by a record fundraising year in 2019, so clearly LP's attraction to real estate lies beyond simple net cash flow, and that figure ticked back upwards in 2019, extending the streak to 7 years of positive distributions. But what is it that LPs are targeting when they invest in real estate? Of course, diversification is at the top of the list, but in addition to general diversification is a low correlation to other asset classes, or alternative asset classes for that matter. Similar to private debt strategies, investors are also looking for a reliable income stream to go along with an inflation hedge in their portfolio, making real estate a great defensive investment for institutional investors. Across almost every vintage year and strategy, real estate funds have delivered IRRs in the low to mid-teens, along with a few outstanding vintages of outperformance from value-added, opportunistic, and distressed fund strategies. Debt strategies have been lagging slightly, but what it hasn't given in raw IRR is made up for in consistency, right around 10% for each vintage since the GFC. That's right in line with returns for the wider private debt asset class and one of the most alluring aspects of credit investments for investors. Looking on a longer time scale, you can see that consistency matters. Real estate debt strategies were the most insulated during the GFC, so investors in the strategy were able to recoup losses first. That initial downside protection, coupled with solid returns and a very low standard deviation across funds in the benchmark, means that debt as a strategy has outperformed the rest of real estate on the recession timeline. And this is after a recession which decimated real estate returns, with the wider real estate benchmark not recovering until 2016. We've already seen the drop in benchmarks as at March this year, but only time will tell how low it ends up going or how protected real estate might be from the consequences of the pandemic. Next, let's look at real estate by their various risk-return profiles across different strategies, as well as their relative size by AUM. By that view alone, distressed managers seem to be clearly underallocated, delivering the second highest median net IRR, as well as the second lowest standard deviation across those selected vintages. Size of the bubble in this graph represents relative AUM. So despite being an outlier due to the strategy's outperformance, these funds only represent $34 billion in AUM. Beyond distressed, however, we see a nice dispersion of returns versus accepted risk, with a fairly linear progression of higher IRR against standard deviation of IRR, allowing LPs to pick and choose their investments based on their risk appetite. Fundraising for private equity real estate managers has really struggled during the pandemic, as evidenced by their totals through 3 quarters compared to some past years. Though not too bad compared to some of the earlier vintages of the decade, real estate is nowhere near the pace of the past 2 years, and the aggregate capital raised is only saved because the few funds that have closed have been historic in their average size. The trend of fewer funds closing has become more pronounced with each passing month. The year started off at a normal pace for real estate managers, but they failed to meet the previous 3-year average every month since, and in recent months have even struggled with reaching double digits in numbers of funds closed. By funds closed, 2020 currently sits at right around 50% of the previous 3-year average pace. And at the current trend, it's likely to finish way below that by the time the year is up. The only silver lining is that the few funds that have closed this year tend to be big, so aggregate capital raised isn't as depressed as it could be. Despite capital concentration trends pointing it to it being a bad time to raise a fund, managers remain optimistic, especially so in Q3, despite it being such a terrible period for fundraising. The last time I gave one of these market updates, the narrative for the year was how fundraising outlook had dipped negative for only the second time this decade, with less managers looking to raise a fund in June than what we had been seeing in January. In just the 3 short months since that update, more than 100 managers flooded into market, launching new funds targeting an additional $25 billion to put the total funds in market above 1,000 funds for the first time in history. This positive momentum is in the face of so many negative indicators. It's a sign of the inevitability and long-term view for real estate. It's long been one of the key asset classes for LPs, and it offers a way to diversify that not many others can provide. And leading the charge for those new funds raising are opportunistic and core real estate strategies. Both of these strategy types have added an additional 23 and 25% of new funds in market between them. Opportunistic strategies are especially notable because they are on pace to overtake value added as the most popular fund in market, but more remarkably, they've more than doubled the number of funds in market compared to the figures at the start of 2019. Clearly, that's a sign that managers are angling to take advantage of the new economic cycle, and LPs will be more than likely happy to back them based on prior returns. The private real estate deal market had been on fire coming into the year, with almost 10,000 deals in both 2018 and 2019, to go along with 3 consecutive years of aggregate deal values in excess of $460 billion. It's now October, and it's very clear that 2020 will be a severe down year for real estate deal activity, and perhaps the weakest year overall since the early recovery years after the GFC. Since the pandemic was declared, real estate deal volume has fallen near or below 50% of the previous 3-year average every month from May onwards, showing nearly no appetite for deal making compared to the robust activity of the last several years. Compared to the previous average, we are just over half the deal volume we'd seen from 2017 to 2019, and that gap figures to keep increasing as we head into November and December. The saving grace here would be that managers seem optimistic overall, and they're trying to build up their dry powder levels. So once social distancing eases up, we could see a flurry of activity in what had been a dead market. Okay, so in summary, real estate's crossed $1 trillion in AUM and become the 3rd alternative asset class to hit that milestone. That's thanks in large part to the great liquidity that the asset class has offered to its investors, returning a net of $350 billion to investors since 2013. By both strategy and property type, there's a nice spread of risk return profiles for LPs to invest in, allowing them to achieve the highly diversified portfolios they seek. The outlier within that spread has been distressed real estate strategies, which have offered the second best risk return profile among any private real estate strategy. Despite the current scenario, 2019 was a banner year for private real estate, with a record level of fundraising, as well as near records for deal volume and value on the year. That's taken a sharp turn for the worse in 2020, as fundraising is down 33% from where we were at this point last year, and overall dry powder levels have seen a rare decline. The drop in deal volume is even more severe, with every subsequent month seeing lower totals than the previous one during this pandemic. The silver lining in there is that managers continue to be optimistic, racing to launch new vehicles, with funds in market passing 1,000 for the first time ever. Chief among those are opportunistic funds, which have rushed to market in recent months as they look to build up their dry powder levels through the pandemic. Okay, thanks everyone for listening. Hope you enjoyed the presentation. If you'd like a copy of the deck used today, you can reach me at the email currently on the screen, and I'd be more than happy to provide you a link where you could download it from. I know I've gone a little bit over. Michael, do we have any time for questions, or do we need to wrap it up here?
No. You have 4 minutes.
Okay, thank you. First question, Matthew C. Does the net IRR figure there include funds using leverage or unlevered or both? The answer there is both. All performance data on Prequin, though, is net of fees and through the eyes of the LP there. Might have had some stuff coming through the chat. Oh, that might have been the only question. If anything else does come up, either submit it now or again, more than happy to take this offline if you want to take down my email here. And I guess if nothing else comes through, we can move on to the next session.
Jesse, thank you again for going through the information. And for those of you that asked for a copy of his presentation, I will definitely send it over to you. It'll take a couple of days, but we'll get you a recording of today's presentation, as well as the follow-up of the slides. Jesse, thanks for coming back again, and we hope to see you at part 8 and part 9.
I'm gonna look forward to it. Thanks, Michael.
Thank you. I'm going to take back control of the screen here, and just go through a couple of minutes. Thank you to all the sponsors for being part of our organization. Your support has helped us to put together over 100 hours documentary of the impact of COVID-19 on direct lending, on private debt, and real estate, the 3 important pillars of the economy. So again, our members are a very diverse group of people, and I appreciate each and every single one of your support and part of our organization. We have a special situations marketplace, which I'll be demonstrating in my session at 3:30 today. But I just wanted to give you the dates for the next event. The next event is on November 19th. If you haven't registered, you can register on the site. And then December 17th for part 9. If you want to speak or sponsor one of the events, please do let me know. Here's a little snapshot of our marketplace. If you haven't checked out our marketplace, please do so. It's flaia.org/marketplace.